let's spend a little more time on the hugely important aspect of reconciliation. Reconciliation. This is a copy of the sheet we were looking at before. So we were looking at differences between, just tidying up my workbook here. So this is a previous version of a sheet I don't need anymore. Here's our original 1A, accounting for sales, a sale for cash on credit, collecting half of the money owed by the credit sale and issuing a credit note. And then we reconciled it at the bottom. We're going to revisit that now. Let's title it up, Reconciliation. So we're reminding ourselves what it is we're focusing on. It means understanding and explaining difference. Cash flow differs from profit importantly. So cash flow or cash inflows for the period are these figures here. Let's shade them like that. And the cash inflow numbers are these ones. Now, cash inflow is hugely important. Profit is hugely important. We'd like to be able to explain the differences between them when there are differences in a consistent way so that it's not something that's going to dismay us and it's something we get some general principles of how to understand. Let's put the profit or loss in gray. Such that the differences are the kinds of things we begin to understand and manage. So profitable entities can run out of cash. So reconciliation at the bottom here, let's modify it slightly, because there's some general principles here that we could explore. So in the first period, there's no difference between the profit, which is 5, and the cash inflow, which is 5. And the reason is there are no timing differences in between the income statement down here and the cash flow statement up here. So neither of these contains any item that is not in the other one. If there is an item in one and not the other, then there's a timing difference between cash and profit or loss. So cash sales, no timing differences, no reconciling items. A sale on credit says we provide goods and services. We're confident of eventual receipt from the customer, so we can recognize it as income, but we're saying to the customer, you don't have to pay us yet. So now there's an item in the income statement that's not in the cash flow statement. It's a reconciling item. And to generalize it, we can say minus, take away, and let's put it in brackets as well, take away increase in receivables. So receivables is the item in our balance sheet that represents cash we're expecting, confident to receive in the future. We haven't received yet, but this item 6 is worth 6. It's going to turn into 6 of cash, all being well, so far as we know, following our activities in the second period. So if receivables increase, then cash flow is going to be smaller than we'd otherwise expect. And it's the difference between the opening receivables and the closing receivables. So what were they at the beginning of the period? Nothing. Cell E7, nil. At the end of the period, there were 6. So they've increased by 6, increasing the items on the balance sheet that represent future cash receipts will reduce our cash. So it's a minus. Our cash inflow is none because the cash is residing in the bank account of the customer. What if things are the other way round? So if there's a decrease in receivables, so minus increase in receivables or plus, shall we call it a reduction? Reduction in receivables. In the next period, we collected 3 that was previously owing. So here we collected half of the 6. We were owed 6, we collected 3 of it. 3 is a receipt. Collecting things we already are owed is not income. It's just a collection. So the assets have transformed from receivables to cash. Our net assets haven't changed. It's not income, it's not an expense, so there's no profit or loss for the period. So all other things being equal, we'd expect no cash flow if everything was on a cash basis, but it isn't, because we gave credit and we collected some. So receivables reduced. So reduction in receivables means things that were on the balance sheet expected to be received in the future are no longer to be received in the future. In this case, because we've collected, so there's items in cash that are not in cash. There's items in income that are not in cash flow. That's the wrong way around. There are items in the cash flow statement that are not in the income. Applaud my error. As you can see, you need to be careful what you're saying. Similarly, in the next period, there's an item in losses. So we've lost 2, but it's not a cash item. So receivables went down again, affecting income because we've unbooked some of the sales we'd booked before. It's not a cash item. So we lost 2 net assets wise. We have a loss of 2 for the period. It's not a cash loss because we're just forgiving or letting off or writing off receivables that we'd recognized before, which had been recognized as income before here, and we're now reducing income, so we're incurring a loss in accounting terms. And if we just calculate this difference consistently, then we'll get the right numbers.